Good morning and welcome to the Edelman Investor Trust Report for 2020. My name is Iain Day. I'm a Senior Director here at Edelman in London. And I'm joined today by a really rather impressive panel who will be discussing the findings. And I'll introduce the panel just in a moment. Just to clarify what we're talking about today. So this is the Investor Trust Report, which is based on a survey of fund managers, top fund managers in 6 different geographies. Here we've got a snapshot of the UK segment, and you can see that the investors we've been talking to, I mean, they're all institutional. They're mostly in kind of active management as opposed to passive, and you can see some of the demographics there. And this survey, we've been running this survey for a few years now, and over the past 2 years in particular, the survey findings have really drawn out a focus in the investment community on the ESG movement, on the environment, societal factors, and governance, which is a big part of what we've been doing for clients. And we wanted to ask the question with the survey this year. Our survey's been showing a correlation between companies that do ESG well and companies that just perform well. And we were keen to tease that out a bit more. And we're also keen to see, does all that hold true when there's a global health pandemic, when lockdowns imposed by governments around the world to contain the virus have had a serious economic effect? Are people still focused on these points? And as we're drawing up the questions, there's still kind of 2 competing schools of thought. Now, we've got some quite interesting findings that have come back on that, and there's some quite nuanced points. So to help me talk through those is our panel. So we're joined today by Stephen Bird, the new Chief Executive of Standard Life Aberdeen, the investment house. By Jacqui Ferguson, a portfolio non-executive who sits on a number of boards, including Croda, the specialty chemicals and ingredients company, Tesco Bank, Wood Group, and she's got relations with a few other big companies. Joined by my colleague Chuka, Umunna, who leads our ESG practice and is, of course, the former Shadow Business Secretary. And also by Jeremy Taylor, the CEO of Lazard Asset Management UK. And Jeremy has got a background in research, used to be head of research at Lazard, and brings that focus to the way that we think about the problems today. And so, essentially, the headline point that comes through from our survey findings is that building back better will see ESG rise in prominence. And obviously, I've had quite a large data point on that this morning from the Prime Minister around the announcement about electric cars and the infrastructure that will go with that. But this has been the message that's come through, that as we come into recovery and we look to the future, ESG is going to be even more prominent than it has been to date. And so, again, just to recap, for the past couple of years, we've been making the point with this survey that investors say there is a correlation between companies that score well at ESG and take a good approach to ESG and those that perform well over the long term. So we've tried to drill down a bit into that this year, and essentially what our investors have told us is that they see 91% of our investors are saying that a company with strong ESG performance is more resilient in a crisis. 86% are telling us that companies that prioritize ESG initiatives are better long-term investments. And so that's why our investors are telling us that a company that has a strong ESG performance deserves a premium valuation on its shares. And so with that framing, it's quite logical that investors are also telling us that they will actively support companies that take actions to shift allocation away from shorter term financial metrics to longer term ESG initiatives, that companies that are reducing dividends or cutting share buybacks in order to reinvest those proceeds in ESG, that's something that they reward. They're also telling us that they are monitoring ESG performance indicators on an ongoing basis, not just once at the point of investment. Now, on this question about the impact of the pandemic, our respondents did say that this year ESG has been placed a bit on the back burner by both investors and corporates. Logically enough, they're telling us that given the market environment, they have changed their investment strategy. And specifically within that, 70% of investors are saying they deprioritized ESG as a criteria this year, which notably is a bit less than the global average. And they're also saying that they believe that companies in which they invest have also deprioritized ESG, at least a little. But crucially, they're also telling us that this is temporary and that the ESG agenda will be amped up in recovery. That as we recover from COVID-19, 87% of investors expect to increase their prioritization of ESG, and 80%, 79% are saying that they expect companies to do the same thing. So on that point, I'm just going to momentarily, just the way we're going to run this, I'm going to run through a few slides and then open it out to the panel, and then we'll share some more slides again. So you won't have to listen to me drone on for a long time. So to open out this to our panel, I'm going to first of all toss this to Stephen, and then Jeremy, and then Jacqui, I think, for a kind of corporate perspective. But when we were discussing this earlier, discussing the findings, it seems there's fairly universal rejection of the idea that ESG has gone on the back burner this year. So Stephen, I'll hand that to you first of all. Oh, you're on mute, Stephen, sorry.
Thank you, Ian. Thanks very much. Yeah, I think that I certainly take the opposite view of this, because what's happened when you have a gigantic stress test, like this pandemic has been for governments, for companies, for individuals. I mean, we've all been intensely involved in the impact of understanding preparation for events such as this, whether they be environmental events or whether they be biodiversity events, or whether they be in fact infectious diseases. So I think that there have been a series of things which have heightened our appreciation. So for example, the localization effects of this pandemic, where supply chains have shortened. So what's happened is that we've all started to appreciate the importance of having a local context that supports us, whether it be for food, whether it be for suppliers, whether it be our employee engagement locally, albeit through distribution. So I think that the pandemic has been a sort of clarion call for be prepared for unintended consequences. So can you sustain yourself? Can you sustain your company? I did see one other survey actually that also took a little bit of another side. JP Morgan did a survey of the top 50 financial institutions, and they 71% of respondents sort of concurred with the view that this impact of this stress test would mean that we would take a longer term view to avoid such things in future.
And have you seen, has this been reflected in clients, or Standard Life Aberdeen's institutional clients? They also seem to be placing a greater focus on ESG?
Certainly have. I mean, my dialogue with clients has been about, how do we prepare for the next one? So in terms of thinking about the future, which is, by definition, thinking, using ESG factors to understand environmental, social, governance impacts, our clients are absolutely having that dialogue with us, and we are seeing continued investment into funds that take that approach.
And if I turn now to Jeremy, obviously Lazard Asset Management, also ESG has been a big factor of your considerations. Has this year been any different? Do you see more or less focus on ESG?
See, I think our approach on ESG is only compounding. So I would really push back on the survey results that you've picked up. I mean, we set out a really strong research agenda at Lazard, and ESG has been increasingly an important part of that. Look, over the last 2 or 3 years, we've been running a materiality mapping exercise across each individual industry, looking at the key issues for each sector, and then really engaging with management teams around those particular issues. And this year has been no different to that continued research agenda. If anything, the engagement we've had with companies has been much larger this year. What we found as we went into the pandemic was that CEOs were sitting at home. They were much more accessible. And so we'd done about 230 meetings, company meetings, within the first 2 weeks of the pandemic. Wow. Because we had great access to the companies we were investing in. And what we've seen from that is that the sort of continued shift in environmental regulations from a top-down perspective and from a bottom-up, as we've seen products kind of shift their focus to meet kind of consumer demands. ESG is actually becoming a more and more relevant topic, for each of the companies we're investing in. The last point I'd say is actually on product development. This year we've spent a long time looking at likes of energy transition strategies, which we've developed with our close clients, as well as more sustainability quant kind of led strategies, which we can get into in the discussion.
That's interesting. So there's kind of two ESG elements there. The fact that CEOs have not been on planes constantly flying around the world has freed up their diary to think about the damage they were causing potentially, I guess. But
I'm sure you're aware of the statistic that to meet the Paris Agreement, this year is the first year from a carbon and greenhouse gas emission perspective that we're actually on trajectory to meet the Paris 1.5 degree agreement, essentially. So essentially, we need a COVID impact for certainly people's use of planes over each year for the next 10 years.
Yeah. And so turning to Jacqui now, to bring the board perspective, the corporate perspective onto this. The companies that you work with, Jacqui, do you feel that ESG has, well, it does seem to have been a bigger priority, but can you talk us through your experience?
Yeah, I would say consistently across all of the boards that I'm involved in, the ESG agenda has definitely been a core focus. So if we just take Croda, the specialty chemicals company, I mean, sustainability is at the core of its business strategy, its purpose and its mission is all about smart science to improve lives. So, and again, also at Wood, a big focus on the energy transition, all about renewables. But what I would say that I'm seeing that's a little bit different from the year before is perhaps it's not all about climate, that the S in the ESG is definitely taking prominence, and a lot of focus on what we do in our communities, what we do with our employees, and that sort of whole concept of being a purpose-led company that gives back to the communities that's involved in, even if it's education or it's helping those communities. It certainly has not taken a backseat in the last year. In fact, with the COVID situation, I think that purpose has come more to the fore.
That's interesting. Now, I'm just going to turn quickly back to some of our slides and bring in Chuka here. So one of the interesting things, ESG, according to our respondents, is increasingly part of the initial investment analysis rather than being a secondary filter. Secondary filter is still the biggest kind of area where ESG comes in, but there is, 29% in the UK, slightly higher in some other geographies. 29% are saying that they bring in the ESG considerations right at the initial point of analysis. And to back up your point there, Jacqui, we're also kind of seeing that companies are telling it, well, the investors are telling us that companies do have to look at all three legs of ESG. You don't get a pass by doing one element well. And looking internationally, actually, as an aside, one of the big interesting things internationally is that Canada in previous years has been very far behind on ESG, which our Canadian colleagues have attributed to the size of the natural resources industry. And this year they've really caught up. But looking consistently globally, in the UK, governance still a bit more of a focus. But Chuka, I was just keen to bring you in, like as part of the work you've done in sort of setting up our ESG practice, you've spent a lot of time looking at the measurement metrics and how people look at things. What's your view on both the importance of E versus S versus G and how investors and companies are looking at the metrics?
Well, thanks a lot. 2 or 3 things, I suppose, to draw out. First of all, completely agree with what Jacqui was saying around the increased focus on purpose. And what we find actually with a lot of clients, we act for corporate issuers, private capital and investors on this, is certainly on the issuer side, there is often a conflation of purpose with ESG, with CSR. And of course, the 3 are quite different things. How I describe ESG is, if you like, it's the answer to the question, where's the beef? When companies produce mission statements and purpose statements. It is a way, if you like, of measuring whether the warm words are followed with action, and in particular measured by the capital markets. I think 2 really interesting things that the data tells us, which, 5 years ago, I do not believe would have been the case. One is that the point at which the analysis is done, the ESG integration comes into play, is tending to be earlier in the process. So just shy of 1/3 of the respondents to this year's survey were saying that they look at ESG at the initial point of analysis. And I believe that is greater than it would have been several years ago. Admittedly, a majority are still saying that it is a secondary screen that they carry out, but it is being drawn into an earlier point in the analysis. The second thing is, who is actually doing this, and what is the structure that we are finding within an asset management house? And some of our clients have a distinct ESG team which sits separate from the principal investment team and will be brought in to provide advice at some point in the process, sometimes a bit later on. But increasingly what we're seeing here is ESG specialists embedded in the principal investment team and contributing to the actual process. So they're not kind of siloed, they're very integral to it. And I think if you look at the results in the data here, in most cases, you've got the ESG integration being carried out by a blend of ESG specialists and the teams into which they're embedded. So I think you are definitely seeing a step change here. And I go back to my time as a shadow business secretary. I mean, to talk about these things, we didn't really talk about ESG in those days. We talked about responsible capitalism. And one of the things that bemuses me is that some of the, captains of industry and big figures in finance who are still around now were so anti this. They kind of accused me and others of being anti-business and pseudo-Marxist. And some of those very same people are now rocking up to Davos when Davos is happening. Of course, it's happening in May, June next year. And they're making speeches and writing op-eds about the importance of stakeholder capitalism and ESG integration. So it's all going in the right direction. But gosh, we've got a job of work to do, as Jeremy was just highlighting, that we've only hit the targets that we need to hit to stop destroying our planet as a result of the pandemic shutting down most of our economies for part of this year.
Yeah. To take it back to Jacqui for a second, on this point around how joined up is the investment community on ESG. You've been out engaging on behalf of some of the boards you've been talking to investors. Do you feel that the ESG agenda is tied up with the investment agenda? Does it feel that way when you're out talking to investors?
Hi, thanks for asking that question, Iain. Yeah, it's a little bit of a mixed bag, frankly. So sometimes when you meet with the investment house, if you meet with the ESG team, you get one message. And then if you meet with the fund manager, sometimes you can get a different message. So I think my sense is not every investment house has that challenge, but it is a little bit of a mixed bag. And the messages that sometimes you get back are a little bit contradictory. And by illustrating an example of that, it's not that the fund managers don't think ESG is important, but perhaps they're looking at it in more of an output-based metric, as in the performance of the company versus those kind of input-based metrics around how you measure the beef that Chuka mentioned. So I'd say still some work to do on joining up the fund managers and the ESG teams in some of these companies. Yeah. Obviously not the ones that are on the panel today.
Well, I was going to turn it now. Well, we'll go to Stephen. How do you feel about that? You obviously recently arrived in asset management from banking. What's your perspective?
Yeah, well, what's interesting here at Standard Life Aberdeen, so the vision, which was mentioned earlier, investing for a better future, is there. But what I did when I got here was I sort of drilled down into at what point in the process do we consider these risk factors, because really, you know, investing is a risk reward activity. And we have it at the very first point of investment analysis, because when you think about it, avoiding the violations, either, you know, the damage to an environment or the violations of regulation, or you're treating your employees properly or treating your clients properly, or having effective governance, or having the appropriate methods of capital allocation, all of those things speak to better run companies that have got a vision for the future. So we make it, this is a genuinely risk management activity. One of the things I was asked to do actually was, I was asked to make an investment. When I got here, I was presented with an investment. It was a data analytics investment, which I approved. And it's about that, you know, you initially look at a company and you look at ESG factors. But what you as an investor want to know is, you want to know that in real time, we have got a pulse of the trend of each of these factors. You know, I invested today, but, you know, next quarter, next year, 3 years, 5 years, is this company making progress in terms of becoming more forward compatible? So here it is absolutely part of the MO of the company, and it's part of every dialogue, and it does inform the way in which we invest and design our data analytics capabilities.
Okay, that's great. Jeremy, to bring you back in, tell us a bit more about your approach here.
Yeah, sure. I think one of the points Stephen made there about companies making efficient decisions is really important here. So what we really focus on when we're investing is returns on capital. So we think about, you know, efficient decisions around the capital allocation of companies. Now, in the modern world, that doesn't just require you know, looking at the return of each investment. It also requires the company to think about the way they're producing products as much as the product as a result of their process. And, you know, I think what the pandemic has done at the moment is really, if anything, accelerate the feedback loop to companies. As technology progresses, you know, social media just accelerates this feedback loop. So it's becoming increasingly important for companies to think about all stakeholders within their decision making. I'd make one other point, and that's around the environment. If we just back up, you know, the last 5 or 6 years, we believe that, you know, environmental regulations and focus around the environment is structurally changing industries. You know, today's announcement from the government is absolute case in point. You know, this has not just come overnight. This has come from Dieselgate. You know, this has been a continuous progression around reducing emissions in cars. And what has that done? That's completely changing the auto industry. Now, that's the obvious example that everyone can look at, but we can pick this out in the maritime sector. We can pick it out in the manufacture of all goods. And I think, you know, if investors aren't acutely focused on these structural changes and challenging management around them, then we're really, you know, they're really not doing their fiduciary duty.
Okay, there's some interesting points I might come back to there. I think I'm going to, just to come back to our slides here momentarily. One of the questions that we're keen to get into, so is this kind of moral question. There's been a big debate about, you know, the social contract between business and society, the division effectively between shareholder priorities versus broader priorities. Now, one of the things that we've found is that in the survey is essentially companies making profits during the pandemic have a greater obligation to do the right thing. Now, so to look at the specific question, we asked whether profitable companies have a greater responsibility to address ESG issues than companies that are unprofitable or struggling. This is obviously all in the context of, does ESG take priority in the year of a pandemic? So on that moral point, this is fairly and squarely in your bailiwick, Mr. Umunna. So I will turn it back to you. What's your view on that? The idea that companies that are trading well through the pandemic have an obligation to do more at this point in time?
Well, I think that the finding that most people have taken issue with is the finding that investors have been easing off the pedal on ESG issues during the pandemic. And I think this is the other side of the coin, is that, look, if you're in a struggle for survival, I mean, Jeremy and Stephen, correct me if I'm wrong, I don't think you're necessarily going to get the stewardship team from an asset management house issuing orders about what they expect, when frankly, you may not be around in 6 months' time. That said, once we are into the recovery zone, which we are entering into now, thanks to the recent announcements on vaccine, then the focus is going to return and it is going to be heightened. And that's what the data is telling us. One of the interesting debates on this that I find fascinating is the naysayers, the haters of the whole ESG movement, if I call them that. And without getting too political, these are the old disciples of Milton Friedman who say, really, it isn't the business of people like Jeremy, Jacqui and Stephen dictating to issuers what they should be doing on environmental, social and governance issues. That is basically a government issue, and the companies here should just focus on the bottom line. Now, the interesting thing is they say that, don't interfere. The other side of the coin is that actually it's the market, it is the clients, the asset managers are responding to. And what we are seeing is this big demographic shift. There is, depending on where you take your figures, there is a $30 trillion asset transfer going on from baby boomers to millennials. And as I said earlier, they're the ones demanding action. And the wealth managers who, clients of ours work with on the asset management side, they're saying that this is coming from the younger people in the family whose monies they are managing. And so to the Friedman people, I say, this is at the behest of the market. This isn't like some kind of command control socialist endeavor. This is what the market is demanding. And woe betide any asset or wealth management house that ignores that, because they will lose business. And I'm not just saying that out of conviction because I believe in ESG, and funny enough, I do, I suppose, given I'm the head of ESG for us in EMEA. It's basically what the market is saying. This is what investors now want, because at the end of the day, as I think Stephen was going to, ESG, if anything, the starting point is as a proxy for prudent risk management. This is why I think, all these people get into the debate on whether it delivers alpha or outperformance, miss the point in terms of the starting point for investors. And actually, I think that the pandemic has illustrated that very well, because supply chain, the resilience of your supply chain, do you know what is going on in your supply chain ultimately? Deloitte did some good research on this that showed that beyond tier one of your supply chain, a lot of businesses haven't got a clue where their products are ultimately coming from. And then when you have a pandemic which shuts down half the world and you don't have things that are local, they're traveling far away, suddenly your whole business seizes up. And so it's a moral thing, but it's driven by younger investors coming onto the market, but also it's, risk management has come to the fore, and resilience has become a big focus for so many of our clients.
Jacqui,
maybe I could pick up on that, Chuka, because I couldn't agree more with what Chuka's saying. That these are actually market forces. So when we engage with companies, one of the first things that we ask is, what do your customers think of you? And then we look for the data. So we look for reuse, we look for loyalty, retention, really being driven by this whole sort of mentality of net promoter score. If you read, Fred Reicheld's book about net promoter score, he talks about you sort your customers into promoters and detractors. Now, what's happened with the Internet of Things and the connecting of the planet and the social media is that clients have got a loud hailer. So Fred Reicheld in his book actually talks about not just detractors, but he talks about brand terrorists, where if you do things wrong, everybody gets to know very, very, very quickly.
Yeah.
So the real economics of this are, we know that when you've got higher loyalty, higher retention, greater reuse, you do get greater superior economics in every category. So it is risk reward management, and what we're getting better at. And I would say that the data is probably 10, 12 years old and getting richer through time. What we're getting better at is really understanding the leading indicators of sustainable performance, which means that we're getting better at risk management. And I think that will become more apparent through time.
How easy is it? I'll keep you in this one, Stephen, initially. How easy is it for a board to say, we are trading really well through the pandemic, therefore we've an obligation to society to do more than all the restaurants or hotels or airlines or other companies that are being, struggling through no fault of their own, effectively because of the impact of the pandemic. Therefore, we are trading well. Therefore, we should make giant charitable donations. We should fund electric car charging infrastructure rollout. Like, how easy is it as a board to actually make that decision, given shareholder primacy is still real, and like how easy is it to have those conversations?
I would look at it in two ways, Iain. I mean, I think there definitely is the social contract that Chuka mentioned. And we've had the discussions here at our board. In fact, we have supported local communities and done things like that. And it was sort of universally accepted that we had an obligation to do that. But the second part, I actually think, is a much bigger impact, is with capital allocation. So when you have a stress event such as this, and you have an acceleration of sort of the winners and losers, you shake the tree, and prior, businesses that were weak or perhaps weren't invested in the best technology or didn't have an internet strategy, those companies have suffered. And there has been a cleavage between winners and losers. And what happens then is that through capital allocation, through supernormal profits, having the ability to double down, we're actually seeing that. You're seeing that in the platform companies, the network companies, the work from home companies. You're seeing them double down on the next generation of technologies. And that's really what's going to propel this, it builds on the behavioral change that's already happened. And that's why I think that it's a major catalyst for an acceleration into different ways of working, more effective use of technology, less damage to the planet. I really think that this has been an accelerator in those regards.
Okay. To flick this quickly to Jacqui, what's your view on the kind of board tensions around this point? Do you feel that, is it easy for a board to say, we are trading well, therefore we've more obligation towards these broader considerations, to broader stakeholder capitalism?
Yeah, I mean, it brings me to one of my boards, Croda, which has a big focus on healthcare and life sciences, and earlier this year acquired a company called Avanti in the middle of the pandemic, I hasten to add, that focused on vaccines and
we seem to have lost Jacqui there momentarily. We'll turn quickly to the next topic. So one of the other interesting stats that we came across in the survey is that a good approach to diversity and inclusion creates financial value. So what our respondents said is that investors want diverse boards, although when you look at what that means, they're broadly saying they want diverse thinking. However, 63% of UK investors are saying that they're screening out companies that fail their D&I hurdles. And then we're also seeing that 64% of UK investors are saying that they are putting companies on watch lists that don't meet D&I thresholds. More specifically, our investors, 80% of UK investors are saying that companies that disclose statistics around diversity and inclusion, this really is a big positive impact on the trust in that company. And as all our Edelman trust barometer data shows, companies that are trusted get a premium in terms of all their relationships.
So Iain, I do apologise. I obviously had an internet blip there.
That's quite all right.
I'm not sure how much of that you got.
Well, we can come back to it in a second, we're looking at the D&I point, which at the moment, so like the main finding here is that, you know, our investors are saying that strong D&I metrics have a positive impact on a company's share price. So on that point, so basically, if companies that do a good job at promoting diversity and inclusion are companies that perform better financially. I'll go with Stephen and then Jeremy on this. Stephen, what's your view on that? Does D&I mean bigger profits?
Yeah, I've done some research on this, and what the largest piece of research that I've been able to access was Morningstar did an evaluation of 745 ESG funds, so all factors, versus their non-ESG counterparts across Europe, and they were able to demonstrate that there was better those funds were better for investors, higher performance. They outperformed their peers 60% of the time. So 6 out of 10 of those sustainable funds actually outperformed. The report actually goes into all the sort of detail of it. But I looked at the very current data, even coming through the pandemic, and through the first half of this year, the ESG funds actually outperformed as well. Now, there's a main factor that drove that was that there was a sort of 1.83% outperformance of those funds versus peers. And the main factor that drove that was that they had lower exposure to carbon industries. So they had lower exposure to oil and gas. So I would say that, because it's important not to, you know, read too much into the data, because it's relatively short time horizon, so a 10-year time horizon. There is emerging evidence that these factors are improving risk management and hence improving investment returns. I think with that, I'll turn to Jeremy, because I'm sure Jeremy will have a view on this too.
Yeah, sure. I mean, actually, there's quite an interesting survey from McKinsey as well, which was done. Another report was published in May this year, and you know, from a diversity perspective, companies with more diverse management teams, C-suite level and a board level, are 25% more likely to be above average in their profitability. They tend to have about a 1 to 2 percentage point higher net margin. And really, you've got to sort of come down to the point where you've got to ask yourself the question, why is that the case? From our perspective, or from my perspective, I would think that companies with a more diverse board are more likely to have a broader diversity of thinking. They're more likely to be thinking about all stakeholders, all challenges, and you know, they're going to be making more efficient decisions. We did a piece of research internally here about 3 years ago, using some of the rating agencies' data, and what we found was that companies with better ESG scores tended to have higher returns on capital. So they were better quality companies. And, you know, so there's no surprise that it sort of follows through from better diversity of thought leads to better financial decisions, better investments, and a better management of a business.
Can I just come in here, Iain, actually, because I mean, these figures are fantastic, actually, because they come off the back of that McKinsey report, which got a lot of attention. I think one of the things it does highlight, though, and I don't think this is lost on many of our clients, is that in order to make these demands of corporate issuers, the city, investment banking, asset management itself needs to get its own house in order on these issues. Financial News did some research into this over the summer and found that just three Black senior investment bankers out of 650 in the City of London. And I know I know all three of them, but it does highlight how basically for the city to make these demands of others, it's going to have to get its house in order. And I think what Jeremy says about companies is absolutely right. I actually sit on 2 boards myself in a non-executive capacity, one of a large company, one of a small company. But the fact is, this is 2020, and 6 out of 10 FTSE 350 boards have no ethnic diversity at all. I think that's unacceptable in 2020, and the Parker Review, and we support it through one of our fantastic directors, Latika Shah, brought this into sharp relief. But, you know, and in fairness, actually, I do think that those who are making these demands get this. You know, if you look at Elgin, for example, have been particularly vocal on this. It is notable that they became vocal after they sorted out the diversity on their board when Rick Lewis joined it over the summer. And so, you know, we wouldn't be having this conversation 10 years ago. It's extraordinary how things have moved, and it does show that you can make progress without the need for legislation and for the threat of action by government. And I think it's really important for business and for all our different financial services sector industries to lead on this. In fact, it would be the worst thing for the need, you know, for regulators and government to have to intervene on this. Imagine how terrible that would look in 2020.
Yeah, but then, I mean, based on what we're seeing here, it seems like that should be unnecessary because the market is telling us that companies.
That's it. That's it. Absolutely right.
You know, obviously that's what the studies are showing. So there should be no need for that. But switching themes slightly, I was going to turn to shareholder activism. So basically, this is one of the topics we've asked about consistently through this survey. Basically, shareholder activism is still on the rise, and not just by activist funds. So more investors are interested in taking an activist approach, is what our survey is finding, and there's very high levels of support for other activists. If there are activist funds out there with good ideas, even about companies, crucially, where the investors say they have a high level of trust, then 89% are saying they would support those activist campaigns. There's also a view that companies are not prepared to handle those activist campaigns. What does activism look like? Well, I mean, the key weapons of choice that have increased this year are withholding votes and voting against pay, which would be two traditional ones. But I think it is also worth noting that there's a high support for launching public campaigns, and investors are not scared to go public on activism points. And interestingly, we did ask whether it was acceptable for activist campaigns to be launched during this current phase of dislocation caused by the pandemic. And 87% of UK investors said absolutely fine, no issue to launch a campaign now. And they're saying that as we recover from the pandemic, there will be an increase in activism. So I just thought maybe we'll go to Jeremy first on that one. And what's the view? Is activism on the rise?
So what I think I differentiate between here is activism and engagement with companies. What we find is that companies want to have an open dialogue with their shareholders. And if you go to them, with a very kind of clear set of, a clear perspective, a real understanding of their strategy, and you talk to them about the capital allocation decisions they're making, and you understand the industry really well, they really want feedback from their shareholders. And we do that on a regular basis, and that involves everything from writing letters through to even presenting to the boards of companies. Activism is also thought about in a slightly negative way at times, and it's really about the threat of going public with the private dialogue that you've been having. And I would hope in most cases we actually have really good engagement with the companies. It shouldn't be necessary for us to go public around specific issues. So our view has always been to engage with companies on a sort of private level rather than to end up on the front pages of the newspaper.
Jacqui, if I could turn to you, obviously in a previous existence you were Chief of Staff to the CEO at Hewlett-Packard when you had an activist on board. Tell us a bit about how you found that experience.
Thanks, Iain. So I would say that activism is not necessarily something to be feared, but something to be handled carefully. So, you know, in our experience at Hewlett-Packard, we had an activist shareholder in the guise of relational investors, quite a well-known American activist house, and you know, their approach was to take a stake, to open up a dialogue, and actually to use data to draw our attention to some things that perhaps we hadn't seen as a management team. And I think what's really important in terms of how you look at the activists is to remember that they are shareholders, just as Jeremy said, and that you know, it's really important to listen to what they have to say. I think activists can come in many guises and have many personalities, and in our experience, the reputation of Relational was actually one of high integrity and of long-term views. So I think it's important to know what type of activist are you dealing with. Is it a long-term activist or a short-term activist, and what are their reputations? But in our experience, it was actually a highly valuable experience. We gave Ralph Whitworth a seat on the board, and he was a very highly contributing board member that helped the company improve its performance. And I do hear from anecdotally from some other NEDs that they too have had good experiences with some of the activist houses, such as, you know, Value Act, etc. But there are other activists that would come in with a different posture, and I think it's knowing what you're dealing with that's really, really important.
Okay, now to stick to our theme a little bit, I'm going to go back to the slides momentarily here. One of the things we're seeing is that activism is going to be increasingly infused with ESG. Our respondents are saying that you know, they are changing their voting policies to be more attentive to ESG, and they are going to vote shares more often to support ESG policy related initiatives, and that this is all going to feed into the kind of questions they're asking companies. It's also key, investors are saying they do expect the board to be challenging issues that are kind of ESG issues, and we've broken those down. A lot of these things, it comes back to our broader point, you know, some of the things that are, you know, being viewed as ESG concerns are just fairly central to how a good company is run, such as health and safety and data privacy, supply chain risk. These are all, you know, they're part of ESG and not necessarily distinguished from just good running, good governance. And also, to come back to Stephen's earlier point about net promoter scores, customers should come before shareholders is a kind of key message. And all of this is going to be, these are all kind of frames of reference for investors as they're kind of coming into these conversations. So I might actually, we could go back to make the broad point. Jacqui, could you actually just go back to telling us the anecdote you were telling us about Croda? Because I think it does talk to this idea that, you know, good companies and companies that are trading well during the pandemic are seen to have this obligation. And we're seeing here that, you know, investors are broadly telling us what the point we made at the point, that, you know, the best companies are ones that think in the round. And so just tell us a bit more about, you know, in the specific situation with Croda, where, you know, you bought this company that is making money through the pandemic and will trade successfully, logically. Just tell us a bit about the approach there.
Yeah, so you know, just taking a step back, you know, sustainability is at the core of Croda's strategy, and we have a focus in health and life sciences in general. And we acquired a company in the summer called Avanti, which works on ingredients that go into vaccines, and we began working with Pfizer on the COVID vaccine. And just a couple of weeks ago, we announced to the market that we have, you know, been awarded a contract with Pfizer. Will be contributing to the production of the COVID vaccine. Now, this has been a great source of pride for the Croda employees, because it's back to that, you know, we are a purpose-led company that is focused, you know, smart science on improving lives. So that's core to the company's DNA. And what's been really important is for us to think about, well, how do we balance this situation in the round. And we had already announced in our last annual report that we would be setting up a Croda Foundation, as a vehicle for us to channel some of our money into a foundation to sort of give back. And we've already talked about the principles around our desire to want to recognize not only any money that we might make out of this vaccine, but also how do we actually channel that back into our communities and into good causes. So I think all of those items that you just showed up on the screen, they are almost all leading indicators of companies that have strong cultures and have I guess a high purpose. And I think that's going to be very important to organizations in the go forward. And I just would like to come back to a point that people were making about how things are changing in companies. I have 3 university age daughters who are all going into the workforce this in the next year, and they're all looking at these elements of the companies, and they are tossing out companies that they will not apply for because they do not like what they stand for. So I think this point that Chuka was making earlier about the next generation coming through has a different idea about how things are, how things are going to be. And if we want to attract the talent into our organizations, in the go forward, we need to be cognizant of all of these dynamics.
Yeah, as you were talking there, it just struck me, it led us on to kind of a final point, which is our first point. Overall, companies that think more about the bottom line produce better long-term performance. That's what our investors are saying. The 93% agreement in the UK and globally that the multi-stakeholder model of governance, where you're thinking about broader stakeholders as well as just shareholders, is more conducive to delivering long-term financial returns. We kind of map out, this is our own in-house view of what that multi-stakeholder model looks like. Jeremy, I'm going to come to you actually, because we were having an interesting debate beforehand on this point. So just thinking about this, if the best companies that do the best job on ESG are attracting more capital because of their ESG scores based on what our survey is showing, does that not mean that there's more value being created in the companies left behind? At what point is there a tipping point where the polluters and the bad boys of the corporate world make the best investments and the best returns?
So this point really comes to the heart of the way that we invest capital. So it's not about thinking about value companies or growth companies. It's actually thinking about quality companies. And quality is all about returns on capital and making good, appropriate financial decisions. And if we think about it, companies with good ESG ratings who are making good decisions about their employees, about the environment, about society, about their products, are also probably making good capital allocations. It's incorporating all these stakeholders together that really leads to better financial productivity, better financial outcomes. And that's where quality companies over the long term have outperformed. We see cycles of value and growth, as you describe, companies which are maybe structurally challenged or have significant headwinds. They come in and out of favor, but quality companies have actually ridden through both of these cycles. The final point I'd make about this entire discussion is that during a COVID pandemic and in a crisis, companies have to make really serious decisions, really challenging, significant decisions. But it's also when they make those decisions that their reputations are built. And I think the way that companies have operated through this period of time will set their reputation for the next decade. I think there's no question about that. And you've seen real differentiating features of companies like Tesco, the way they've managed their employees through to other businesses. And I think that's the single point I'd leave with the audience today.
Yeah, and employees is definitely a big factor. And we see in all the data that the companies that are most trusted and the companies that are most considered quality companies by investors treat their employees right. as we're in this second lockdown in the UK, how are you finding treating employees? And I might flick this to Stephen after. Like, you know, how easy is it, especially in a regulated financial business, to have people working from home? You're having to place a lot of trust, and obviously the FCA has been onto this. They issued some guidance the other week about, you know, so finger wagging guidance reminding people that you've still to make sure you're avoiding insider trading. There's some glib comments about how do you know someone's not photographing their screen and WhatsApping it to a friend. How do you get that balance right between supporting people through the pandemic and working from home, yet being cognizant of regulatory responsibilities and managing traders and all that sort of stuff?
Well, I mean, for us, it was very much about preparation at the beginning of this. So I remember in the middle of February sending everybody home, getting them to test their laptops, getting them to test our trading systems. We were running with half our traders at home even before we reached March, just to make sure that as we saw the pandemic coming from China, coming into Italy, we were already testing the way that we were going to operate. We are a regulated business, and we're managing clients' capital, and it's incredibly important that we don't lose the four eyes oversight, you know, the compliance culture. And, you know, a lot of this comes from just the routine in the way that you work during the week. You know, we have regular calls, we're in regular contact. We don't leave employees working away on their own, you know, in their bedrooms at home without support. You know, they need to be constantly engaged, you know, in their teams, you know, working together, checking each other's work, checking trading, the same oversight that we'd have as though we were in the office. There can't be a difference when we're working from home than when we're working in the office. And actually, ultimately, in the long term, this is why I think there's going to be a structural change in the way that people work going forwards. And companies will have to and do trust their employees more, but they have systems in place that mean that it's not just an open trust or a blind trust. It's actually a trust which is part of the company's process, you know, from trading, implementation, you know, through to the decisions we make from an investment perspective.
And Stephen, if I could turn to you, obviously there've been a few remarks during the pandemic about, you know, how difficult it is to start a new job working remotely. You've taken that to extreme, running a very large global company while a lot of your staff have been working remotely. What's your view on this remote working point?
Well, I don't think that we're ever going to go back to the way we were. I mean, yeah, I came into the company and there were very few people here in headquarters. But what we were able to do, we effectively distributed all of our staff and kept the same tech infrastructure. So to Jeremy's point, there was no, we've got the same controls, but I do believe that there is an essential role for people coming together. We're a social species. You know, what is the half-life of culture? You know, culture eats strategy for breakfast. I think it's a mistake to think that you don't get something from collaboration, innovation, and this bonding as human beings. So I think that the role of the office will be different. And we are actually remodeling already. I did a test zone here in Edinburgh. I have a much larger test zone being done in London. And it's responding to our employees. I actually spoke with we have an employee forum. I spoke with an employee forum yesterday, and many of them were saying, look, Stephen, I need to be able to get out of the house. I'm doing my job. I'm on set, I'm on Teams, I'm responding to clients, but I really would love to be able to solve this bigger problem with these other people. So obviously COVID restrictions, we are fully compliant with everything because we have to be, but we're planning for being able to operate in this blended environment where we get the best of the lessons of the pandemic, distributed technology, but we really bring our best brains together to be able to collaborate, innovate, and reinvent, because that's what our job is. We're not caretakers. We got to lead into the future, and leading requires courage. Leading requires to take, challenge, convention. And I think it's wrong just to say everybody's out there. I mean, what is the half-life of culture? I'll leave that question. Culture needs to be built. needs to be replenished. It needs to be fed, and we're focused on doing that.
I think that's a fantastic point to leave it. We are a minute or so over time, and I think that is a good point to leave it on. That, you know, culture is the most important thing in an organisation, which talks exactly to this ESG agenda and why it's so logical. And to be honest, the more I engage with the conversation around ESG personally, the more you realise that the contents of it are just good business, and it goes back to, you know, the original principles of good business kind of set out by Adam Smith and others. It's long-term sustainable capitalism, and so I think we all seem to thank you all to the panelists for giving so much time and for such a fantastic debate, and thank you all for watching. And that leaves us. That's it for today. So thank you once again.
Thank you all.
Thank you very much.